Hey everyone, this is Tammy Chambliss, and I wanted to put out a new video that has some recommendations for trading in this market. I know it's been tough. It's been tough for me. I've heard from many of you that you're losing more than you had in the past, or losing more often, and you're asking for ideas of what can you do in this market. So I wanted to put together a quick video. This won't be a long one, just to talk about what I'm doing, what's going on in the market, and what I'm doing to adjust for what's going on in the market. So this presentation is for informational purposes only. The presentation and all information contained herein is not investment advice and not intended to be investment advice. Any trades you make based on this information are your responsibility alone. The presenter disclaims any liability, loss, or risk resulting directly or indirectly from the use or application of any of the contents of this presentation. Standard disclaimer. So today, what we'll cover, I'll just briefly go over how I trade credit spreads so we're all on the same page and know what trade we're talking about or what strategy we're talking about. I've got a brief blurb on setting stops on the short leg versus the spread. So I've got several slides showing what's going on in the market lately, and is it different than typical? Is it unusual? And then I've got some information about the expected move versus the actual moves we've been seeing, and then how can we use this information in our trading, diversifying with multiple entries and managing stops a little differently. And then I've got a few updated resources. So we'll get started. I have put out prior videos on, and they're extensive videos on how I trade the zero DTE credit spread. You can search on YouTube for, and that's my cat in the background. You can search on YouTube for videos under Tammy Chambliss Zero DTE Credit Spreads. And the more recent videos are more up to date with how I'm trading, but this video has some even further updates that I've made. Just so we're all on the same page, the basic strategy is to enter separate puts and call spreads, usually trading around delta 5 to 10 and buying a long or selling a short leg around delta 5 to 10 and buying a long leg that is 25 points further out of the money. I don't enter a full iron condor at the open. There are other people that trade that way. That's not how I trade and not how I recommend trading. Not saying it can't work, but I think what I do is a little more responsive to what's going on in the market, and you may have a little better results with this. I usually wait at least 15 to 30 minutes to see what the market action is. And I'll enter calls on a move up that looks like it's turning around, or enter puts on a move down that looks like it's turning back up. So I try to use that market action in my favor, and that way, hopefully we can reduce some of the stop outs. This is just my basic strategy. This is not a recommendation for this market, but we'll talk about that. Then I set a stop on the short leg for 3 times the initial credit that I received on the short leg. I don't enter a stop on the whole spread, and I'll explain that in a minute. I close the long leg manually if I get stopped out. And there's a bunch of reasons I do that, and I go into those in the past videos. The basic trade, here's a put credit spread. And I'm not going to go over these because I do that in the other videos, but just a diagram to show you what I'm doing for those who may be viewing this for the first time and haven't seen my other videos. But please watch those if you haven't seen those. Then I get a question all the time about setting stops on the short leg only. People ask, I get this question, I'm confused. If you put a 3-time stop on the short leg only, won't your loss be different than a 3-time stop on the spread? If you just close the short leg, isn't your 3 times stop loss price different? And yeah, if you just close the short leg, but I also close the long leg as soon as I get stopped out, usually. And here's an example. Let's say you sell a put for $1 and you buy further output for 30 cents. The net premium would be 70 cents. Then you put a stop on 3 times the premium for the whole spread. So that would be $2.10. And if you get stopped out, your loss is $2.10 less the initial credit of 70 cents for a net loss of $1.40. Now, if we compare that to just putting a stop on the short leg, so you put a stop for 3 times the premium on your short leg, and that would be, we sold that short leg for $1, so 3 times $1 would be $3. And if you get stopped out, your loss is $3 less the dollar initial credit. So your net loss on the short leg only is $2. However, you still own that long put, which has increased in value because that trade has gone in that direction of the long put. Usually, and this isn't exact, but if your short leg is tripled, your long leg will also increase by about 2 or 3 times. So let's say that, or in the example, that long leg cost us 30 cents, but now it's worth 90 cents. So if we sell that 90-cent option and subtract the initial cost of 30 cents, we had a net gain of 60 cents. So we take the net loss for the short option of $2 and we subtract the net gain on the long option of 60 cents, and that equals $1.40. So either way you do it, it's the same. You're stopping either the whole spread out at a certain price, or you're stopping the individual legs out at a certain price, and they total up to the same loss. So that, and I will say that's roughly the case. Sometimes, in a fast moving market, that long leg can actually gain in value after you exit, and it may reduce the size of your loss. That's happened many times lately because we'll get these huge moves, and if I leave the long leg on, that just keeps gaining in value and I reduce some of my loss. It can also work against you too. If that long leg starts declining in value, then you're not going to recoup as much for that as you would have if you got out, exactly when you got out of your short leg. So, maybe your total loss or net loss is a little bit higher, but the point is you're using stops, and that's critical to this strategy. So either way you do it, your loss is going to be roughly the same. So I get that question all the time. I wanted to address it in a video. You can look over the info in this slide and make sure you understand it. And please email me if you still have questions about it. I don't mind emails, and I just want people to understand. So we'll move on from there. So what's happening in the market lately? Here are a few of the things that we've seen. There is a lot of news-driven market moves. COVID happened. That was affecting the market in 2020, a little less so, but if we had another spike, it might affect the market again. We've got inflation going on, and it's the highest that it's been in the trading range that I'm going to show. So it's actually the highest since, I think, I don't even know the date, but it's the highest in years. And that is definitely affecting the market. And I think the market's trying to figure out what to do about that, or how to build that price in, and what that's going to do to the economy, if it's going to cause a recession. It's definitely causing interest rates to increase to try to control that inflation. Then we've also got supply chain issues, which can affect individual companies. We've got Ukraine, which we don't know how that's going to resolve. So there's just a lot of unknowns in the market right now. And all of these are causing higher volatility in the market. And these influences or these news-driven events have caused larger than normal intraday swings in the market. And I'll show you some examples of that. I did a little research and looked at this slide shows the past 11 years, and from January 1st, 2011 to current, basically May 6th, or I'm sorry, May 5th was my data. And so you can see, oops, sorry. Well, that may not have affected you, it affected me. Okay. So you can see that in the current year, you can see right here, that the swings are definitely higher. They're not really that much higher than they have been historically, except for COVID. So, we have seen moves before in the 4% range, 3 or 4% range. We're just seeing a lot more of them recently. You can see how kind of spread out they were. And, 2016, 2017 was a nice long bull market. Volatility was super low during that time. But even then there were some, almost 2 or just over 2% moves. But lately we've just seen more of them. And then you can see on this chart on the bottom, the high of the VIX by day over the same time period. And we're definitely in a higher average VIX level of around, somewhere between 20 and 40. And, it's just popping up and down in between those, which is higher than average. Like for years, it was around, 20 was around the highs, with an occasional pop up to 40 or 50, a VIX of 40 or 50. Of course, COVID, it got much higher than that, with the VIX around 85 at the high. But just it's been sustained high levels of VIX over the last 2 years, I'd say. So that gives us some broader context. Let's look at what's going on the past year. So this looks at from the 30th of April in 21 to it's actually 5/5/22, so a whole year. And you can see from April 21 through about 11/21, the swings were, from about 0.5% to 1.5%. Occasionally they'd get up to 2, not much more than that. And then 21, December 21, they got higher. And then you can see in January, I know a lot of you contacted me in January saying, what is going on? I keep getting stopped out. Every trade I put in gets stopped out. Well, you can see why, because these moves, the daily point swings as a percentage of SPX, was just huge in January. And it stayed high through May, or through at least through April. We'll see what May brings, but it's just been consistently high in 2022. So we are dealing with, a little higher average VIX levels, but definitely bigger point swings in the SPX. And to look at that, that looks at it on a percentage basis, which I think is informative because you're comparing apples to apples. And the next trade just looks at it based on the moves. So the average swing, and to be honest, VIX hasn't changed that much. I mean, it's been high since April 2021, but the average moves are definitely higher since January through the current period. So I would say it's more than double what it was the first 6 months of this past year. So last April through October or so. And so that's why we're getting stopped out more. It is hard to trade when you've got 120 point moves, 160 point moves, 180 point moves. Even, I typically think of, my stop buys me about 20 to 30 points worth of protection. So this is saying almost every trade would get would get stopped out because every trade is 40 points. Every day has a swing from the high to the low of 40 points or more. So it just makes it very difficult to trade in this market. So if you've been experiencing higher than normal stop outs, or you just started trading in this period and you think, what the heck, this isn't performing anything like what Tammy said in her original videos, just be aware that this market has changed. Today's market is different. So it will settle down at some point. This can't continue forever. We may go into a recession. We may go into a bear market. That will be new for this strategy. So I tend to think that the delta or the probabilities of the trade are always still in line with option pricing, but these huge moves, it's just difficult to trade. So, but it can be done, and I'll show you ways to do it. So another slide shows you moves on the put side from the open to the low of the day. So you can see if you entered a trade at the open, you're dealing with 80 to 120 point moves sometimes, and very often 40 to 60 point moves. All of those will stop you out. So it's just been a difficult market. And then to compare that to calls, there's also big moves on the call side. It's a little less volatile on the call side than the put side, but there's still big moves. You're still going to have more stop outs than usual. So I wanted to put this information out there because I thought it was pretty helpful to understand what's going on and how to view it. It felt different. It feels different than it felt last April through November. It really is starting in December is when it just seemed to like every trade I was getting stopped out on. So another way to look at this is, I know a lot of you use expected moves, or you look at expected moves. Tasty Trade marks the expected moves on their option chain, and TOS, I believe, shows expected move. What I did here was just use VIX to calculate the expected move. The volatility is a key component of the Black-Scholes model, and increased volatility will bring in additional premium, which will help you from being stopped out, or help prevent you from being stopped out, but it may not build in enough premium. So especially with these huge moves. So I did a study of looking at the daily expected move versus what the actual move was. And this was kind of interesting. So the blue is the actual move, and the orange is what the expected move would be based on the VIX at the open. Now, that's not exactly the right way to calculate expected move. You need to use the IV of the option you're selling. So the VIX is basically the volatility of at the money puts. So it's a little bit off, but I still think it's telling. I don't have a way to calculate the actual expected move or go grab that information. So I roughly approximated it here. But you can see this again is the 11-year period. So there was a period in early 2011 where we had a lot of moves outside the expected move. And then there's a period where sometimes it's below and sometimes it's above. It evens out a little bit more. Yeah, there's always going to be days that exceed the expected move, but there's going to be a lot more days that are less than the expected move, because supposedly the IV is overstated, or volatility is overstated, but not always. So this gives you an idea over the past 11 years. And yeah, looking at that, I wouldn't think that what's going on currently is much different than what's gone on. But if I look at just the past year, then and this is a much more close-up view, so you can see each day's price compared to the expected move. The expected move is the orange line, and the actual move is the blue line. So you can see where the actual move was a lot less than the expected move, and times where it was more. So in the first 6 months, we had, maybe 10 or 12 times where the actual move exceeded the expected move. But look, since December, how many days we've had where the actual move exceeded and greatly exceeded the expected move. So to me, that I'm seeing on this chart why it feels different to trade in this market. So it's, you can't say I'm going to use the expected move and put my trade on at the expected move and feel safe about that, because roughly I'd say 30% of the time it blows through that expected move. So here's a case where the move was greater than the expected move, and this is over the 11-year period. And you can see there's a lot more the negative numbers show where the expected move was less than, the expected move was less than the actual move, but the positive numbers show the move where it was greater than the expected move. And it just shows a lot more, somewhat more moves lately, especially in the last couple of months or since the first of the year. So then looking at just the last year, you can see definitely since January, it's very rare that we're within the expected move. This shows the positive numbers show where the actual move was greater than the expected move, and the negative, the black line below the line, shows where the actual move was less than the expected move. So there's maybe, I haven't counted them, but 15 or so days in the last 4 or 5 months that have been less than the expected move, and all the other days have been greater than the expected move. So that's very different, in my opinion, from what had been going on in the past. So what do we do with that information? So how can we use this in our trading? So be aware that the likelihood of being stopped out is higher. So it then would be expected by the delta. I don't think this information is built in yet into delta, because that expected move based on the volatility or the VIX is not accurately predicting the actual moves. So it's somehow out of sync with what's going on. So be aware that with this higher volatility, the likelihood that a trade that is profitable can change to a losing trade very quickly, and vice versa. A trade that's losing could switch to profitable. It's just every day we get these huge price swings. It may be down in the morning, and then it bounces way up, and then it comes back down later in the afternoon. So it's just been very unpredictable. And so premium is also very volatile. What you're going to get for an option at any one time in the day is going to be very volatile. Used to, you'd know that premium kind of decays throughout the day, and it's going to be less toward the end of the day. But these days, it tends to hang on because of that volatility and because of gamma. So can we use this to our advantage? I think we can. There's things you can do to trade in this market. One thing you can do is choose not to trade in this market. You can wait until things get back to normal. That's perfectly okay. You can pick and choose your days if you want. Not saying you're going to know in advance what any one day is going to do. So that's a little risky. But if you just want to step aside and wait till the expected moves get closer in line with, or the actual moves get closer in line with the expected move, that's fine. Or VIX reduces somewhat, or we get through a series of rate hikes and the market's tending to calm down a little bit, and we see if we're going to get inflation under control. You can wait until some of those things work out. But a lot of us like to trade. So what else can we do? We can elect to trade smaller. If you've been trading 10 contracts, you might change to 2 or 3 contracts. If you're trading 2 or 3 contracts, you might choose to trade SPY and trade even smaller. So that's another option. One thing you can do is avoid being in the market early in the morning and late in the day. To me, those seem to be the more volatile periods. There's been some huge price swings right after the open. We'll often, either the market will be way down and we get a huge bounce up, or the market will be up and we get a huge bounce down. I try to avoid those times and wait until those bounces we've gotten past those and we kind of see what direction the market's going to go in for that day. It's an art. It is not a science. So, you got to get good at reading the chart and seeing what's going on. But early in the morning and late in the day also, we seem to get some big swings toward the end of the day. Those seem to be the more volatile periods. So you could elect to avoid those periods and trade when the market is a little bit calmer. Not that it is, but it does seem to calm down kind of the middle of the day. But I have been working on some modifications to the strategies, to the basic strategy that allow us to trade in this volatile market and still capture some profits and manage our losses. So there's several things. I guess the three-legged stool of this is diversifying with multiple entries, and I'll explain what I mean there. Managing our stops a little bit differently, and managing our profits a little bit differently. So I'll talk about those in the next slides. One other thing you can do, and rather than trade by delta, you can aim for a certain credit per spread. Like I try to aim for $1 to $1.25 credit per spread, and that. You may want to trade a little further out and get 60 cents a spread. That's fine. But just as long as you're consistent with that pricing, then what that will do is in higher volatility, like if we get VIX spikes up to 35 or 40, then that will naturally push you further out away from the market with your trade. As volatility settles down, and the VIX goes down, aiming for that credit will naturally pull you a little bit closer to the money. So I think that's helpful to trade that way with higher volatility, rather than using delta, because sometimes a delta 5 trade, the pricing can vary drastically. And so what that means is, if you're getting different credits on different days because of VIX, then your risk is a little different. And we always want to manage these trades by what we can lose in the trade. So we always have to be aware of that. Watch some of my other videos and you'll see I recommend risking no more than 2% in any one trade. And these days, actually, I've reduced it for myself to 1% or less. And just because I got tired of losing and I didn't want to take any more big losses. So I'm fine with a 1% loss. That's no problem. But these multiple days where I'd have 2% losses, they can add up quickly. And in January, I did that. I got hit a bunch of times, got down in January, and I'm still working my way out of that. So the strategy I'm going to talk about with modifying, or diversifying the entries, managing the stops, and managing profits, I have been at least break even, if not positive, on the months since then for February, March, and April. So it's been a good way to trade. I feel like I'm able to manage it in this market. And frankly, the theme for this market is survival. This is a tough market to trade in. Just live to trade after we get through this, and things will get good again for this strategy. So just protect yourself in the meantime. So what I mean by diversifying with multiple entries is, rather than taking your account and figuring out what your 2% loss is or 1% loss, and figuring out the number of contracts that means you can trade, rather than putting all that in one trade near the open, what I've started doing is entering 3 or 4 times on each side, and I'll enter a portion of those contracts that I would normally trade. If my risk tolerance normally allows 12 contracts, I might take those 12 contracts and divide them into 4 contracts for 3 trades and enter at different times based on what's going on. That way I may get stopped out on one of those, but if that market's moving against me, I may have a great entry when the market's, say, moved way up and I got stopped out on my calls, and I enter another trade up there, and I get, I'm trading my dollar premium, so it puts me further away from the market, and then the market turns around and I'm golden. So I've maybe had 1 stop out, but I've got 2 good trades, and then I'm good on the put side. So that's tending to be what's happening with this lately. It is difficult to backtest this, so I don't have the data that I usually have on these trades, but I have been live trading it, and it's working out very well so far. At least I'm surviving. And so when I enter strikes, I try not to enter the same strike, because then my risk is the same. I try to give at least usually around 10 points away from my other strikes. So as the stock price moves, I may have 1 trade at a certain level, another trade a little higher if the market came up and moved against me, and then 1 trade 10 points lower, closer to the money, just depending on what the price action is that day. And then I try to wait at least 30 minutes between entries. If you enter 1 trade and then right away the market moves, and you enter another trade, and then 15 minutes later the market moves again, I don't like that method, because you're just it's happening too quick. You're kind of getting in the same market conditions with each of your trades. I want to trade different, kind of what's going on a 60-minute period. So I'll enter, say, from 10 a.m. Eastern time, and I don't use the clock. I don't say I'll enter at 10, 11, and 12 Eastern time. I don't do that. I watch what's happening in the stock and try to sell calls when we've got to move up and it looks like it's turning and going to move down. That's time to get in calls. And then once we move down and it looks like we're turning, that's a good time to get in puts. So I space them out based on what the stock is doing. And I describe that in some of my other videos. So especially the, I believe it's the July 2021 video where I talk about that method in detail. Then the idea behind this is to spread the risk out. So rather than put it all in on 1 strike and getting stopped out and taking my 2 times loss, at least I've got a shot of, maybe I've got a partial loss, but maybe some of them are successful. Worst case, if they all stop out on one side, I still have my whatever my target loss is. If it's 1% or 2%, that's the max loss I can have that day. And then once I hit a maximum loss I'm willing to take, I stop trading. So I don't try to re-enter and revenge trade and get some of it back. I've just found out that in my experience, that just never works. And I don't make good decisions and trading more emotionally then. So I try to just let the, once I hit my max loss for the day, I'm done. And that way I'm controlling my risk as well. So the next thing you can do is manage stops a little bit differently. Normally in this trade, when we enter a trade, we will put a stop on the short leg for 3 times the initial credit received on the short leg and close the long leg separately. We will still do that. However, if you wait to close that long leg with these big moves, sometimes that long stock can make up a portion of your loss, if not all of your loss. In December, I had several trades in a row where I made up the whole loss on the trade by hanging on to that long leg. And I think that can happen in these moves where we've got these 120-point moves in a day. I think that can work well in your favor. I usually get out of my long leg when it stops increasing in value. So you want to hang on to that profit if you capture some profit. Now, the stock can kind of go up and down, so it's a judgment call how long you want to stay in that long leg. But just be aware that you can make up some of the loss with that long leg. And then the new thing to this, if the trade goes in my favor and I get to 50% of the potential profit, I'll move my stop to break even, or a 1 times the initial credit, so that if the trade does, if I've gotten to 50% profit and then it starts moving against me, at least I won't lose money. And then, if I do get stopped out at a break even and of my short leg and I still have my long leg on, I can make some money with that long leg. So hang on to that. So that's one thing I'm doing differently. And then to continue that theme, as the trade goes in my favor and I get to 50% profit, I'll move my stop to break even. But if it turns around and starts going against me, I won't lose money. So I set the stop for the initial credit to receive on the short leg. Sorry, that's basically a repeat of what I just said. Close the long leg separately. But another thing that I'm doing is, if the stock continues to move in my favor, so I'm at 50% profit and it continues to move in my favor, then I start tightening up my stop. And basically what I do is take the current premium in the trade and set my stop for basically 1 times that, or for 1 times net loss. So I take that premium, let's say the premium is at 50 cents, I set the stop for $1. If the premium is at 30 cents, I set the stop for 60 cents. If the premium gets down to 15 cents, I set the stop for 30 cents. And usually there's a point at which I stop doing that. But what happens by doing that is, as a trade moves in my favor, things are going good. And sometimes this can happen pretty quickly with these big moves. Things are going well. My trade is profitable. I want to protect that profit. I want to stay in as long as possible. And I could just get out and take profits. That's fine if you want to do that. I kind of like setting a stop and giving it a little bit of room to keep moving in my favor if it will. And then if it doesn't, I still capture some of the profit. So I keep setting my stop, adjusting my stop tighter and tighter. And if I get stopped out then, and I'm at greater than 50% profit, I will make money on the trade. It might not have been as much as I would have made if I'd left it to expiration and everything works out great. But in this market, I have seen too many times trades that will turn around and go against me. And I was profitable, I was very profitable on the trade, and the market just turned around and tanked on that trade, and I lost on that trade. That was frustrating. So by doing this, I can hang on to a portion of the profit if the trade is profitable at some point. And if I do take a loss, my losses are smaller than the full 2 times net loss on the trade. So this has been very helpful in this market. It involves a lot of paying attention to what's going on in the market and making adjustments to my stops, but I can tell you it's worth it. I've found that trading is more profitable and less frustrating, and I feel like I have some control of what's going on. So those are the things I recommend in this market. As always, I recommend the Tasty Trade Options Facebook group. There's the link for that group if you're not a member. There are some questions you need to answer to join the group, and it's a good group of people. I highly recommend it. You can email me, tamchambliss@gmail.com. I love questions, and you'll find sometimes it may take me a few days to get back to you. Sometimes I get a bunch of emails, and sometimes I just get an email a day, and that's fine, and I respond to it. So I really do enjoy interacting with you guys and answering your questions and making sure you understand what my intent is. And then if you like to do back testing or your own back testing, you can do manual back testing with OptionNet Explorer. I've recommended that before, but there's a new software available that came on the market or available to the public recently called Option Omega. You can look them up at optionomega.com. The cost is approximately $50 a year. Their back testing has intraday data, which is great. Most back testing software I found is end of day data. Does no good for back testing zero DTE strategies or really any 5 days to expiration, 7 days to expiration strategies. You've got to have intraday data to back test those. The guys that developed this did a great job of setting this up. It is automated back testing. The OptionNet Explorer is not. It's manual back testing. So this, you set up a strategy and then you run it over a period of time. It's very flexible. They've got a lot of different strategies built in, and you can make it a lot of adjustments to your stops and strikes and things like that you want to use. And if you want a 50% discount, you can use this link and just type that in, optionomega.com /register/Tammy Chambliss, and that'll get you a 50% discount for whatever period of time you sign up for. So I'd recommend signing up for a year and getting a year at half off. That's like $300. So it's a good deal, and it's a great software. I looked over that software when the guys that were developing it were working on it, and gave them some feedback of things I thought they ought to have, but by far it's probably the best back testing software I've seen. So I highly recommend it. And I'm glad to have an intraday automated back testing software to recommend. So that's the end. Thank you guys. Glad this was a shorter video, maybe 30-40 minutes. And again, there's a disclaimer. Email me if you have questions, and best of luck in your trading. If you are trying something new and you think it's working well, let me know. Or if you try these strategies and they're either working or not working, or you have questions about them, let me know. I'd be happy to discuss these strategies with you by email or on the Facebook group. And I'm going to post some of these slides on the Facebook group, or probably a link to this presentation. And so you guys get it there. And a shout out to the Tasty Trade Facebook group, anybody who's a member there. I appreciate all of you and all of your posts. So thank you guys. And that is the end. So let me figure out how to stop. So thank you again.